Good afternoon, ladies and gentlemen. Welcome to the Team Internet Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet Company dashboard. Before we begin, I would like to submit the following poll, which will appear on your screens now. And I would now like to hand you over to the executive management team from Team Internet Group PLC. Michael, Billy, good afternoon.
Good afternoon. And good afternoon, everybody. Thank you very much for joining us today on this Monday afternoon. My name is Michael Riedel, Group CEO of Team Internet Group, and with me today is Billy Green, Group CFO. And as we'll see on the next slide, we've changed our typical presentation structure slightly. So we today have the Q3 highlights section directly followed by the financial results section. And Billy will run you through both of these sections, and I will then take over to conduct you through the business profile and the strategy and outlook for the group. Billy, over to you.
Thank you, Michael. So just starting off with an overview of some of the company's financial highlights for the 9 months ended 30th September 2023. Those of you who have followed Team Internet Group PLC, formerly Central Nick Group PLC, those of you who followed us for a number of years will know that the Team Internet story has been one of consistent and impressive revenue growth. We've continued to deliver growth both at a gross revenue and at a net revenue, i.e. gross profit level over the last 9 months. You'll see there that both gross revenue and net revenue grew year on year. What's particularly a focus of the company and what's particularly pleasing is that not only are we delivering increased revenue, but also our delivery of profitability. Adjusted EBITDA continues apace. The adjusted EBITDA of the group grew by 11% year on year. And in what's quite a tough trading environment at the moment, to be able to grow our adjusted EBITDA by a double-digit percentage is very pleasing to the group, and it's certainly something that we hope will be continue to be replicated in the near future. As we'll come on to later in the presentation, the delivery of profitability obviously doesn't just stop at the adjusted EBITDA level. We're very focused as a management team and as a board on delivering profitability right the way through the P&L, right down to profit after tax. So the fact that we're posting a impressive profit after tax level is something that is part of our commitment to add real bottom line profitability and objectively to create additional shareholder value. In terms of other metrics that we track as a management team and as a board, the earnings per share of the business continues to grow year on year. That's obviously impacted not only by the earnings growth that's coming through, but also by the reduction in the volume of shares out in the market. We several months ago entered into and then expanded a share buyback program, which we continue to execute on. We're happy to use the company's cash reserves in a moderate manner in pursuing buying back shares of the company, and that's something that we're continuing to do. And as part of that, we're comfortable with an increase in the level of net debt that the company services. The net debt of the group was just over 80 million at the end of 2021. It then decreased to 56.6 million at the end of 2022, which we regarded to be quite a low level of debt for a group of our increasing scale. So we've been quite comfortable with a moderate increase back up to 81.7 million as of the 30th September 2023. And the reasons for those increases in net debt I'll go into in more detail slightly later in the presentation, but they are closely related to returning cash to shareholders and associated mature uses of cash. In terms of cash, we continue to generate very strong operating cash flow. Our adjusted cash flow for the year ended, the 9 months ended 30th September 2023 was 65.6 million. And it's quite pleasing to see that that was even in excess of the amount of cash flow generated in the comparative period in the prior year, because I considered 2022's very robust, very strong record cash generation for us as a group. I consider that to be a very tough comparative. So the fact that we've delivered slightly more operating cash, adjusted cash this year is something that I consider to be an achievement of the business as a whole. And as you'll see in the bottom right-hand corner of the page, the free cash flow yield of the company continues to be, at the very least, highly competitive. Taking a slightly deeper look at the company's financials, the previous slide presented the GAAP revenue and profit growth of the company. We've also been tracking for many years what the real underlying organic revenue growth of the group shows. Those of you who have seen previous Team Internet Group presentations will have seen that we typically put up on screen how our organic growth looks by adding back into a comparative period the additional revenue that would have accrued if all of the constituent parts of the group would have been the same throughout the entire period. So by adding into the LTM Q3 22 numbers, the additional little green sliver on top you'll see there of what the additional revenue would have been if we had owned all of the constituent parts of the group throughout the entire period, you'll see that even after adding back that amount into the prior year comparative, we drove a still significant volume of organic growth from the LTM Q3 22 into LTM Q3 23 of 20% in the online marketing segment. But not only did we experience impressive levels of growth in online marketing, but we experienced a higher than usual, higher than average, certainly higher than any year I've experienced, level of organic growth in the online presence. So the legacy domain procurement business, to have driven 17% growth within that relatively steady state, typically single digit to high, mid-single digit to high single digit segment, to be able to deliver 17% growth is something that is out of step with what our delivery has been in the past. So quite objectively, online presence is having a good year, and it re-illustrates for us the importance of that part of our business and our operation of these two interrelated businesses in different corners of the internet. In terms of KPI growth, you'll note that the KPIs of the company continue to support the impressive delivery of the group. The continued huge growth in volumes in visitor sessions on the online marketing side of the group means that even in a period when RPM, so click-through prices, click rates, price points are somewhat challenged in the market, and it's something that we've never shied away from directly confronting, when there are good times for RPMs and click prices, and there are not so good times, and we are currently in a downside of the digital marketing cycle. Even in a period when click prices are compromised and challenged, the continued growth in the volumes of the business means that we continue to grow our absolute dollar value revenue, absolute dollar value net revenue, i.e. gross profit. And in a period when RPMs, and this is the same across the board with our business partners and our competitors, we're very, very, very comfortable with the levels of growth that we're seeing in what's not the best time in the market. On the online presence side of things, within the online presence segment, the picture is more consistent and clear. We've seen growth both in terms of domain years and growth in terms of price metrics. So a very good year for online presence, a good year in the industry generally, but a specifically good year for Team Internet within the online presence segment. As we've alluded to in previous presentations, we strive to be the leader, the market leader in each of the segments in which we operate. Whilst there is no one business that is completely analogous to our own business models, there are naturally a couple of peers that we look to, and we operate in the same ecosystem as these peers, and we look to these peers, particularly as, if you go back a couple of years, System 1 Inc. within the online marketing segment, and the domains segment of 2Cows within the online presence ecosystem. These were very objectively the market leaders up to a couple of years ago. And over the last several years, we've caught up our market share to within a few percentage points of parity. So we're very pleased with the way in which we've grown into those markets. We already had very strong positions in those markets 2-3 years ago, but we've continued to grow into those markets over the last several years. And that's an ongoing process. And we look forward to giving you future updates about our position in those markets as part of future presentations. Reining back into what's actually going on within Team Internet and how we're able to generate such impressive growth and growth in market share. We've made public in recent quarters several strategic partnerships which are starting to generate more material amounts of revenue for the group. Those partnerships with companies such as Klarna, Sovereign, Booking.com and Shopify. Those are all deals that we closed earlier this year and are now starting to have a real revenue impact for us. So really starting to contribute to the profitability of the group. They are each individually quite different, distinct deals, and they are a sign that whilst we've always been very pleased about our ability and the openness of very large digital marketing companies to do business with us and to have long-standing strategic relationships with us, we're hopeful that we can also open up more business with the leaders of tomorrow, the companies that are going to be the digital marketing leaders in 1, 2, 5, 10 years' time. It's important that we've got quite a diversified outlook and that we are in business with all of the major players of the future. On the online presence side of things, the launch and growth of AI-powered domain search. We were the first company to launch an AI-powered domain search tool within our Internet BS retail platform, and that's been very well received by retail consumers, and we expect to be talking about that for many years to come. We're not just investing in new products on the online presence side of things. On the online marketing side of our business, so the digital marketing side of the business, we recently launched a new product called Absolutely, and I won't steal too much of the future of the presentation. Michael will be giving a little bit more of an overview of Absolutely later in the presentation. In terms of the company's equity structure, I alluded earlier to the company's share buyback program, which continues apace. We have completed nearly 2/3 of that share buyback program, which was committed to a level of up to 34 million sterling of buybacks, or 28.9 million shares. Given that we're not quite 2/3 of the way through that program, there is still a long runway, good capacity for further share buybacks over the next several months and into next year. So we're certainly not finished or nowhere near finished with that program, and we look forward to and have earmarked cash to continue to deliver on the remainder of that program. Taking a slightly deeper dive in terms of the financials of the company, these figures are still 9 months ended 30th September, so they still give the a good tail on the numbers. You saw earlier in the financial highlights the growth in revenue and adjusted EBITDA, and I promised that you would see growth in terms of the company's profit after tax. So profitable delivery right the way down the P&L to a profit after tax of 13.8 million, which is a record level for Team Internet. And it's our anticipation and our strategic aim that we will continue delivering profits after taxation, so real bottom line profitability, so that we're objectively delivering as much shareholder value as is possible. I can't pretend that it's always one-way traffic. Whilst most operating metrics and most financial metrics are going in the right direction, anybody that looks a bit closer at our operating profit, so our GAAP operating profit year on year, will see that we did experience a 5.3 million decrease in the level of operating profit, comparing the 9 months ended 30th September 2023 compared to the 9 months ending 30th September 2022. And whilst we would like to deliver increased operating profit every single period, the demands of GAAP indicate that's not always possible. There are two factors why operating profit is not quite of the same level in 2023 as it was in 2022. One is we experienced and benefited from a non-recurring foreign exchange gain of 6.1 million in the 9 months ending 30th September 2022. And given that we are reasonably risk averse in terms of our approach to foreign exchange, we've hedged more of our our non-US dollar activity in the 9 months ending 30th September 2023, and we've therefore arrived in 2023 at pretty much a nil gain, nil loss situation with a small 100,000 net foreign exchange loss. That does mean that our results are negatively impacted by the absence of what was a fairly significant gain this time last year, but a non-operating gain and a non-recurring gain, so not part of the recurring operating cost base of the business. Likewise, you'll see that the line amortization of intangible assets has increased by 7 million year on year. This is primarily a non-cash charge because it primarily relates to delivery of it relates to amortization of intangible assets in respect of acquisitions. We've been a fairly acquisitive group over the last several years, and every time we make an acquisition, we account for that acquisition and we capitalize onto our balance sheet goodwill and intangible assets in respect of the purchase price allocations for those acquisitions. We then amortize the intangible assets to the P&L over the estimated useful economic life of that asset. And as we've added more intangible assets to our balance sheet, so the intangible asset amortization charge increases, which impacts operating profit, but is a non-cash charge, and therefore there are no underlying concerns for us in the decrease in operating profit year on year. And whilst we're hoping to get to a point very soon where we'll be delivering increased operating profit as well as all other financial metrics, that one shows a slight decrease year on year, and yet we are showing an increase in revenue, adjusted EBITDA, and absolute dollar value bottom line profit after tax. In terms of the balance sheet of the group, I alluded earlier to the net debt of the company increasing since the 30th September last year and since the end of last year. But that increase in net debt is part of a quite manageable, quite anticipated cash evolution over the course of the year. We've returned cash to our shareholders in two ways, one of which is by the payment in Q2 of this year of our inaugural dividend, and the other material method of returning cash to shareholders has been the share buyback program that I've described earlier. Those were not the only material cash outflows outside the operating cash of the business. We've also settled deferred contingent consideration liabilities to the tune of $17.9 million this year. That is a non-recurring cash outflow that reflects earnouts that we've paid to the management of companies we've acquired over the years. And that is something that we have paid out the largest chunk of the deferred contingent consideration liabilities that were on our balance sheet, and we now anticipate no further deferred contingent consideration payments, earn-out payments in the same materiality of those we've experienced over the last year or so. The final slide in terms of detailed financials. The cash generation of the company continues to be strong, but not quite at the level at which I had targeted at the start of this year. We always target greater than 100% cash conversion, and whilst we were successful in achieving that target, delivering 110% cash conversion in 2022, the first half of this year was a bit more challenging for us in terms of cash conversion, and we have only caught up now to 95% in the year to date, 30th September. We hope to deliver closer to 100% over the remainder of this year, but we strive for perfection and we strive to achieve more in terms of cash conversion, and we will continue to target delivering in excess of 100% cash conversion for the remainder of this year and into next year. And with that, I will hand back over to Michael for a closer look at the business profile.
Thank you, Billy. And I think we all agree that the results are quite satisfactory. And so this is why in the next two sections, we will focus on what makes us so successful today and how do we plan to keep it that way going forward. And the the principal force behind our success is that we don't only own one successful brand, but actually have a full portfolio of brands which all conquered market leading positions in their relevant niche markets. And the list begins with Tonic, where we are the leading Google AFD based media buying platform. AFD stands for AdSense for Domains, where basically Google ads are shown on otherwise empty domain names. We are also one of the market leaders on a global scale in classical domain name parking. And given that the first two products are responsible for more than half of our entire revenue, we will also share a few slides on how exactly the user workflow looks like for these products. And without going through the entire list, it then ends with our oldest brand in the stable, Centronic Registry, which is today 27 years old, an almost biblical age in terms of the internet. And it is still the number one platform for the provisioning of so-called new top-level domains, which are all the new top-level domains that were released after the deregulation of the market in 2012. And you might have already seen some on the internet like .xyz, .icu, .online, .site, and many others. So here we hold roughly 45% global market share. Next slide, please. So here's basically an overview of the entire flow of demand and supply through the different brands that we operate. As you may know from our Capital Market Day, when we announced our rebranding as Team Internet Group, the overarching theme is creating meaningful and successful connections. So our success lies in connecting otherwise disconnected or disjoint ecosystems like social media with search engines. And here you'll see the entire map where we have a whole series of different supply side pools and demand side pools. And we are constantly adding new categories of supply and demand to it. And within each category, we also constantly and incessantly we're adding new partners, both on the supply side and on the demand side. What you can, however, see here is that as of today, on the demand side, there is a certain concentration on search, where we operate with our two products, Tonic and Parking Crew, which, as I mentioned before, are responsible for this 67% of our group revenue. And on the next few slides, we are going to present to you how exactly the user experience looks like and just how successful we are in making connections here. Thank you. Have you moved on? May I just ask the studio? Yeah. Good. So Tonic qualifies and monetizes referral traffic globally. What does referral traffic mean? It basically means traffic that is referred from another source. So here we put ads on social media, on any kinds of websites on the open web through networks like Taboola and Outbrain, so-called native networks, and also to some degree on other search engines, and then understand these consumers and match them with search ads that others have booked on Google or other platforms. So here you see some statistics on the right-hand side on this. So more than 10 million visitors every day, more than 250,000 different campaigns for different products and services in more than 160 countries. So very broadly diversified, absolutely no concentration on any specific sector or vertical. And then you see the supply sides with TikTok and Facebook being two of our most prominent partners, together with Taboola and Outbrain. However, there is more than 30 other networks that are also connected to us. Just there was not more space on the slide. And on the right-hand side is, of course, on the demand side is our core partner Google, but also here we've struck partnerships with Yahoo and more recently Bing, and revenues from these two sources will then also increase over time. And on the next slide, you basically see how this looks on an iPhone. And I'm not sure whether the video will play. Normally all the three iPhones should be animated, but I'm not sure whether this video platform supports this. So on the left-hand side, if the videos will still start to play, you see a website about soccer, which you would find on any kinds of news or sports websites. So news and sports websites are typical websites where we would be very successful. Where embedded in the article, you would then find product suggestions, and when you click on them, you would then be referred to one of our websites, where we will then present you with a selection of the most relevant advertisers for the specific user. So basically, every customer journey is bespoke. In the middle, you would have seen someone searching for a mobile contract without credit scoring. Again, very similar process. You enter it, you type it in. One of our websites would then appear in the search results, and from there you then basically engage on or embark on the consumer journey. And on the right hand side, there is a TikTok example. TikTok is today our most prominent source of traffic, where when you would then click on the so-called short form video, you would then again be referred to a customer journey where we would then first suggest a few related search terms, which is industry lingo for simply subcategories of the keyword of the ad on which you have clicked, and from there you would then be shown the ads of the actual advertisers that fit the consumer's intent the closest. Is it only me? But it seems the presentations are not playing. But anyway, we will try to make them available in the playable mode on the internet, if on our website, if possible. Next slide, please. And then we have Parking Crew. Parking Crew is in the end the basis on which we've built Tonic. Parking Crew already dates back at 12 years to 2011, and so the technology platform is very similar. Also, the workflow is relatively similar. So you could almost understand Tonic as Parking Crew on steroids. On Parking Crew, we also have significant numbers of traffic sources, 32 million domain names, which is almost 10% of the 354 million domain names in existence, point at any point in time to our services, and despite the fact that these are all empty websites which don't have any active content on them, they still attract more than 300 million visitors every month. And the monetization here is very similar, with Google and Yahoo as our main partners. And but here also Zero Park, our 2020 acquisition in Poland, comes into play. Zero Park monetizes our traffic, for which Google and Yahoo don't have any competitive ads on their in the network. And Zero Park also does the same thing for most of our competitors globally, which gives us very interesting competitive intelligence. Next slide, please. So in here, I guess the video will also not play, but again, apologies for this, but we are going to try to fix that when we release our presentation on our website. So on the left hand side, you have seen the mobile flow. Why do we see a mobile phone and a desktop here? In Tonic, we really focus on mobile traffic. This is where we are the most competitive, and today also mobile traffic is much more significant than desktop traffic. However, in domain parking, still a lot of the traffic comes from desktop when people just sit in front of their keyboard and enter domain names into a browser bar, which happens less frequently on a mobile phone. But from here, the process is basically the same. You enter a domain name, you go to, and it would then basically domain name would then not have any content other than relevant ads that match the user's intent. Next slide, please. So what are we going to do? What are we going to do in the future? So we've recently launched a new product called Absolutely, and I hope you find the name absolutely great. And what Absolutely does is basically pushing our contact point with the user one step closer to the user in the work experience. So rather than first having the user to click on an ad that we booked with someone like Taboola and Outbrain, and then going through the entire chain, we would basically deliver this new ad format Absolutely directly to the publisher. The Absolutely ad container will then read the content of the website and automatically detect what are the most relevant keywords for advertising for this website, and from there the workflow looks exactly the same as with Tonic. So no further distraction from any competing content. Just showing the most relevant commercial offerings to the consumer. And as we've shown before, each year more and more people are excited about this and engage on consumer journeys with us. 5.6 billion in 12 months ending the 30th of September 2023. And on the right hand side, you can see that we're also currently in an early test with our partner Google for a new product called Related Search on Content. So here we would also try to go one step further and basically disintermediate native networks and place ads directly into the content on the website. Here the difference is that we don't go through our classical ad only user workflow, but we would then show search results which may also include non-paid search results. So and here we will need to see will the loss of people who click on non-paying links be outweighed by the additional advertisers that are opting in for this format. But as you can tell, we're constantly trying to keep more of the cake for us, and which is more like the right hand side, and on the left hand side, and on the right hand side we're also at the same time trying to grow the cake. Next slide, please. So strategy and outlook. So this is not a new one, but I expect the slides still to be around for many quarters to come. So our strategy is about creating a virtuous circle, which starts with a laser focus on organic growth by winning new customers, growing our existing customer base, launching new products, contracting with new suppliers, all the things that we just explained to you. And this organic growth, together with our efforts on managing our cost base, leads to operating leverage. And Billy has mentioned before that our so-called EBITDA conversion, so EBITDA divided by our gross profit, is systematically increasing over time and has now finally reached 50%. So we now spend 50% or less of all the gross profit that we generate on internal cost, and we endeavor to further grow this ratio. This operating leverage then again translates into more competitive cost of capital. And here at the end of 2022, in October to be more precise, we had a major crystallization event on debt. And when we refinanced our bond, we were able to reduce the interest margin. So that's basically interest that we pay on top of the market rate from 7% to 3%, testament to the materially reduced credit risk and improved business case of Team Internet Group. And this is why this year we've turned our attention to managing the other side of the equation of the cost of capital, which is the cost of equity, and our new dividend policy and share buyback program both feed into this objective. And the more competitive cost of capital will then again allow us to do focused bolt-on M&A acquisitions. We are going to address one of them a bit later in this deck. And the additional bolt-on acquisitions then create new adjacencies that help us identify new potential for organic growth, because we can then again attach new suppliers or new demand side partners to our value chain. Next slide, please. So where will this lead us in 10 years from today? And it would be a very daring guess predicting how exactly online advertising works on the internet in 10 years from today. And already today it is very different than it was in 2013. There are, however, a few things which we can guarantee, which is first, it will be more diversified, meaning that we will put particular focus on growing the revenue streams outside the Google universe, which doesn't mean that we will seek growing our Google relationship, but we must also build other similarly successful businesses on the side. The business will also be even more global than it is today. And when I say this, I don't mean that we will sell in more countries. We are generating revenue from almost every country on this planet. However, today we have a mix of 51% of revenue coming from the Americas, most importantly the United States, and then 49% from the rest of the world, Europe or EMEA and Asia Pacific. And while this is great because it demonstrates that we have notable scale also in the very important US market, but we also have a very healthy business or scale of business outside the United States. And this is something that we want to celebrate and reinforce and do more of. And then the business will also be more vertically integrated. And let me explain to you what we mean with this over the next few slides. Thank you. So we've spoken about Tonic, and Tonic is great at attracting consumers on so-called low-intent media websites, social media, news websites, sports websites, or other things where you can't really tell in which products the customer might be interested in, and match these consumers with the exact right search ads that other people have booked on Google or other search engines, and make money out of this, despite the fact that we need to share the click price with Google or our other partners. And then we have a second business model operated by our company VGL, who operates under two brands, Vergleich.org in Germany and Meilleur.fr in France, who can pay the full Google click price, or you could also substitute Bing. The names here are more for illustrative purposes, and still make money because they are so great at converting the search ad traffic into actual transactions at Amazon or other e-commerce partners. And now just imagine when you combine these two skills into one superpower, and you could actually take users of social media, say TikTok, and drive them through a modified workflow directly to e-commerce partners and translate them there into e-commerce transactions. The potential for margin enhancement are of course dramatic, and we don't necessarily see this model substituting the other model, because all the things that are now highly profitable should still work, and there are also some services which escape this, like for example our largest service, which is our largest customer group, which are actually US dentists. There will not be any shippable dentistry sets anytime soon. So some verticals will simply escape this mechanism. However, the universe around there for shippable e-commerce goods being sold through social media websites is estimated by McKinsey to be worth $80 billion by 2025. And this is why Meta and TikTok have their strategies, and Amazon has their strategy to tap into this. However, we are also confident that our strategy will also have its place in this game, because while the others bet on the fact that they could be the best social media and e-commerce company at the same time, our model is based on connecting the best social media platforms and the best e-commerce companies at any point in time. And this flexible approach is what has already made us successful in Tonic before, where we were very quick to repivot from being very Facebook heavy to now being more TikTok based than before. One quality of the business model that we are basically very agnostic on both the products or services that we advertise and the networks from which we source our partners. And this flexibility gives us the resilience to also grow the business in times like 2023. Next slide, please. So Adrenalabs, while it is a small acquisition in terms of our history, it is still very relevant. And again, Adrenalabs addresses a similar theme, just translated as the one that we just discussed on the prior slide, just translated to domain parking. So our Parking Crew product. And Adrenalabs is basically taking traffic from platforms like Parking Crew and its competitors, and rather than using it to display ads that other people have booked on Google, it would match the users directly with advertising campaigns that e-commerce providers have booked. Again, very similar theme. And this is also very important. And one very important aspect that I would like to add here is the following. So we already today thinking of the world 10 years and 20 years ahead. 30 years ago, when online advertising slowly started, and let's not forget that Amazon has only been started 30 years ago. Most online advertising was on a so-called PPM model. PPM stands for pay per thousand. The M stands for Latin mille, meaning thousand. I don't know why no one has called it PPT. Anyway, this is how advertising worked at that time. The advertiser had to pay for every viewer of his ad, whether they clicked on it or not. And this was of course very inconvenient for advertisers, and over time this has migrated to now the so-called PPC model, pay per click, being the dominant form of online advertising. So the advertisers over time have won the upper hand and would now only pay the website operator when a user actually clicks on the ad. However, our conviction is that another 30 years in the future, so-called PPA, pay per action, will be the dominant form of advertising, where the advertiser only pays any money when there's an actual outcome, ideally an actual sale. And our products, Vergleich.org and Meilleur.fr, and also now Adrenalabs, are near 100% based on these PPA principles. So here we've basically bought ourselves a foothold in the future, while we, through the mechanism that we just showed to you on the prior slide, will gradually shift larger parts of our today's PPC based revenue streams into the future that we expect to unfold over the next few decades. And with that, I think we come to the last slide, correct? And so in summary, Team Internet is operating in two highly attractive markets: high growth digital advertising, which we refer to as the online marketing segment, and domain name management solutions, which we report as the online presence segment. In the first, we are creating privacy safe consumer journeys with AI in order to convert users of general interest media into highly confident consumers. And in online presence, we are a critical constituent of the entire global online presence and productivity tool ecosystem, with a focus on the domain names of domain names, but also other digital products that are associated with domain names like SSLs for certificates, for example. On the right-hand side, you can see that that while you might not have necessarily seen us in the wild, because we largely work through partners like Google or GoDaddy, WordPress, and many others, 5.6 billion online consumers who engage in our customer journeys is a clear sign that this is not a niche phenomenon, but a mega trend. 14 million domain years processed. That is more than 4% of the entire number of domain names registered each year. And we are also global, as referred to before. 51% of revenue currently comes from the Americas, and 49% from the rest of the world. And because of the strong underlying demand for our services, the directors expressed their confidence in us trading at least in line with the current market expectations. And also importantly to state, we are also confident that with the high cash reserves that we have, committed credit lines, and the strong cash generation that Billy referred to, we are fully funded to simultaneously invest in our future and at the same time return money to our shareholders. With this, we end the presentations. Thank you very much for your attention, and we are now open for Q&A.
Perfect. Michael, Billy, thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Billy, Michael, unfortunately at this time there are a few investors that are struggling to get in attendee side. But as you can see, we have received a number of questions throughout your presentation this afternoon. So if I may just hand back to you just to read out those questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Yes, very, very happy to. And I would probably combine the first and most recent question received, which is about net debt and share buybacks. So there was never. What should be very clear is that we have not borrowed in order to buy back shares. We made our decision to buy back shares because, in the board's opinion, the share price is unnaturally low, and I can also see from the question that some of you would agree with this. And so we've made a commitment to only reserve a small part of our 2023 cash flow for M&A activity and return the rest to our shareholders, partially through a dividend, which we paid, I think, in early June, and the remainder through a share buyback program that should give or take use the entire authority that the AGM has given to the board earlier this year. So that is the intent. The reason why the debt figure has gone up is that also deferred consideration payments for past acquisitions have become due, which were very successful, and this is why we see this this small increase in the total debt net debt number, which still stays below 1 times net debt to EBITDA, or around 1 times net debt to EBITDA. And we have a firm bank pool. Our debt is still good for many years. We have very favorable debt rates. We have locked in a very good portion of the debt through hedging contracts. So we have been currently paying way below market interest rates, and we felt it was the right thing at this stage to rather buy back shares, which hold a 15% free cash flow yield, if I remember Billy's slide correctly. Whereas on the debt piece, we would not even pay half that, and that is before tax. So after tax, the interest charge would maybe only be 35 to 40% of the cost of equity that we currently have. However, for those who are worried about the debt level, what is very important to us, and we understand that trust is the most important currency in anything you do. And this is why, or at the occasion of the annual report 2022, we included a cash flow allocation waterfall model, which clearly lines out how we would allocate our free cash flow. And what we've done this year is exactly in line with this policy. So shareholders can always count on the company doing exactly as it promises, unless maybe force majeure events, which you can never exclude in life. But in this policy, you will also see that there is also that we've also have drawn in the debt ceiling, because you understand your concerns, while management is very comfortable in the quality of our returns. We have committed to put in a ceiling, which is in writing in our annual report, so you can rely on us respecting the ceiling. Maybe then a side note, which is a bit of a twist of the first part of the question, that is whether the board have any intentions to increase their personal holdings, given the present bargain levels. So many of our investors, like for example Kestrel, have been systematically buying shares in the market, and I would not be surprised if they start engaging in more share purchases soon. I personally have taken my holding in the company up from 1.1 million shares, which I had in 2018 when I was appointed as group CFO, to today 2.7 million shares. And while some of that was coming from stock options, even on the stock options, I then settled all the tax from my private funds, not selling any shares to settle any tax liabilities. So there's a very strong commitment by the management board to be strong holders in the company, and we are confident in that at one time the market will hopefully discover that the share should be re-rated, and until that time we will be loyal to the company and put our money where our mouth is. And I should also not add, as a last comment on this, implicitly, you will also see that none of the board members ever sold that Billy and I and Kestrel never sold any shares into the share buyback, which implicitly also means by foregoing selling our pro rata of the share buyback, our personal share constantly goes up. So I hope there are enough tokens of evidence that the management board and the anchor investor are firmly committed to the story. There was a question on online marketing. The relationship between the number of visitors and the revenue per 1,000 sessions. So the number of visitors is basically the number that you see on the screen. 5.6 billion people came on one of our websites, and we then showed relevant products and services to them. And the revenue per 1,000 is basically the number, how much revenue we generated out of each 1,000 of these sessions, which is a number that actually dropped. It will not be a secret to anyone here that the online advertising market is currently not in its strongest cycle, or in a down cycle. But the important thing here is there are two important mentions. First, it is a cycle, as it has always been. There will also be better times when the prices, when the click prices go up again. Secondly, it shows that we can actually outperform the market. So if you would dissect the quarterly click price reports that Google issues, you would have seen that the average Google click price diminished by 14% in the same comparative period. So we've been doing 7% better in relative terms. And the last point is, in the end, is our job to create as much value for everyone on this call and everyone who's also not on this call. And we still have strong levers to increase the number of visitors by constantly adding new social networks, native networks, or exploring new product verticals, which would then again attract new groups of online users. And just in the 12 months that we reported on now, we were able to increase the number of people who actually engaged on our journeys by 36%. And despite the fact that the average revenue per 1,000 dropped by 7%, we were then still delivering notable top line growth for the business. I'm not sure how we are on time. Here is basically a question that asks to give a forecast, which of course difficult as a public company. However, a reasonable expectation would be that the user growth will slowly come down, simply driven by the fact that once we become really big, keeping certain percentage rates stable becomes more and more difficult. So next year, a 25% addition in the number of visitor sessions would mean actually the same or a similar level of absolute gains in terms of users. But one can also take a little bit of hope that maybe the online advertising cycle is approaching an inflection point. So for Q3 2023, Google has for the first time in I think like 2 years or so reported a notable positive evolution of the click prices. I'm always saying only in Q3, not for the 9 months year to date, which could be an early sign of the worst being over. On the other hand, there's also no guarantee that we're really already out of the woods. probably this year Thanksgiving and Christmas season will be very indicative of whether this was already light at the end of the tunnel or a short-term recovery. But as you have seen, even during a period of 2 years of consecutive trouble in the online marketing industry, we've still been able to deliver very notable growth rates, and also growth that translates into increasing earnings and cash flow. And this is why we are confident that we will still be around when the market finally picks up, and will then become one of the key beneficiaries of the market inflection.
Michael, Billy, if I may just jump back in there, and thank you very much indeed for addressing all of those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform, and we'll notify all the investors when they're ready for their review. But Michael, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments just to wrap up with, that'd be great.
Sure. Using the answer to the last question as a segue, Team Internet Group has demonstrated that we can deliver financial results in any kind of market condition, both the hype cycle when everyone was making money, but also in the down cycle when only the best can make money. And I hope today was helpful to you. We try to be one of the more accessible management teams on the market. So should you come up with any questions after this call, feel free to reach out through your usual channels, and we will try to get back to you as soon as we can. Thank you.
Perfect. That's great. Michael, Billy, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Team Internet Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.